The Minority Market. Episode 73. Patience, the most profitable skill in markets. Most people enter the stock market searching for fast results. They want quick profits, instant validation, and rapid growth. The minority understands something uncomfortable. Patience is not just a virtue in markets, it is a weapon. It is the skill that quietly separates long-term winners from emotionally exhausted participants. Markets reward those who wait. But waiting is psychologically difficult. Human brains are wired for action. We feel productive when we click buttons, place trades, and react to movement. Doing nothing feels uncomfortable. It feels unproductive. This discomfort pushes people into unnecessary trades, poor entries, and emotional mistakes. Patience begins with accepting that opportunities are not constant. Markets move in cycles. There are periods of strong trends, periods of consolidation, and periods of chaos. Trying to force profits during low-quality conditions damages capital and confidence. The minority waits for clarity instead of forcing activity. Another reason patience is powerful is compounding. Wealth grows exponentially over time, not linearly. But compounding needs time to work. Frequent buying and selling interrupts this process. Transaction costs increase. Emotional decisions increase. The minority allows time to do heavy lifting quietly. Patience is also required during drawdowns. Every strategy and investment experiences losing phases. Beginners panic during these periods. They abandon plans, switch strategies, and chase new ideas. The minority understands that drawdowns are part of probability. They stay disciplined, reduce risk if necessary, and allow systems to recover naturally. Another important aspect of patience is waiting for confirmation. Emotional traders jump early into breakouts, reversals, and rumors. They want to be first. The minority prefers to be correct rather than first. They wait for structure, alignment, and confirmation. This reduces false signals and emotional whiplash. Patience also protects mental health. Constant trading creates stress, fatigue, and burnout. Waiting reduces emotional pressure. It creates mental clarity. It improves decision quality. Calm minds make better decisions than excited ones. Long-term investors also rely heavily on patience. Strong businesses do not deliver value overnight. Growth takes years. Innovation takes time. Market recognition takes patience. Selling quality assets too early destroys long-term compounding potential. Another form of patience is holding winners longer. Many people cut profits quickly because of fear of losing gains. Meanwhile, they hold losses hoping to recover. This behavior is reverse logic. The minority allows winners to grow while controlling losses quickly. This simple behavioral shift dramatically improves performance. Patience also teaches humility. It reminds you that markets do not operate on your schedule. You cannot demand profits. You can only prepare and wait. This humility reduces ego-driven behavior and emotional pressure. Another powerful concept is selective participation. You do not need to trade every day. You do not need to invest in every opportunity. The minority chooses quality over quantity. Fewer high-quality decisions outperform frequent low-quality actions. Patience also strengthens discipline. When you practice waiting, you strengthen impulse control. You reduce emotional reactivity. You train your mind to tolerate boredom and uncertainty. This mental training pays long-term dividends. One of the biggest mistakes beginners make is confusing activity with progress. They believe more trades equal more learning. In reality, thoughtful reflection, journaling, and observation often teach more than constant execution. The minority values reflection as much as action. Markets also reward patient capital deployment. Instead of investing everything at once emotionally, the minority scales entries, waits for favorable conditions, and builds positions gradually. This reduces risk and improves average entry quality. Another important lesson is patience during market crashes. When fear dominates, most people sell emotionally. The minority prepares mentally for these moments. They remain calm. They observe opportunities instead of reacting emotionally. History shows that patient buyers during fear periods often benefit long-term. Patience does not mean inaction forever. It means acting at the right time with clarity and structure. It means waiting for alignment between mindset, market conditions, and opportunity. True patience is active waiting. It includes preparation, analysis, planning, and self-control. It is not laziness. It is strategic discipline. The minority understands that impatience is expensive. It costs capital. It costs emotional stability. It costs long-term opportunity. Meanwhile, patience compounds quietly in the background. When you master patience, trading and investing become less stressful. You stop forcing results. You stop chasing movement. You begin flowing with market rhythm instead of fighting it. Remember, the market does not reward speed. It rewards discipline, preparation, and time. Those who wait intelligently are often the ones who win consistently. Patience is not boring. It is powerful. It is the silent advantage of the minority. In the next episode, we will explore how to observe markets without reacting emotionally and why calm observation is a core professional skill.